Finland is the happiest country on earth, a place known for high living standards, strong social systems, free education, universal healthcare, and a quality of life that most countries can only dream of. Yet behind this image of happiness lies a quiet economic problem that is slowly growing and often overlooked because while Finland ranks at the top in happiness, surveys its economy has been facing challenges that raise serious questions about long-term sustainability. And this creates a fascinating paradox. How can a country be so happy while its economy struggles? And to understand this, we need to look beyond surface-level indicators and dive into the structure of Finland's economy, because happiness as measured in these rankings is not just about wealth or rapid growth, but about stability, equality, trust in institutions, and access to essential services. And Finland excels in all of these areas, with low corruption, high levels of social trust, and strong government support systems that ensure people have access to healthcare, education, and social security, which reduces stress and improves overall life satisfaction. But, at the same time, these systems are expensive to maintain and require a strong and growing economy to support them. And this is where the challenge begins, because Finland's economic growth has been relatively slow compared to other developed nations, and one of the main reasons for this is its reliance on a limited number of industries, which makes the economy less diversified and more vulnerable to global changes. And historically, Finland's economy was heavily supported by industries like technology and manufacturing, with companies like Nokia playing a major role in driving growth, employment, and innovation. But when Nokia declined, it created a significant gap that the economy has struggled to fully replace. And although Finland has made efforts to diversify into sectors like clean energy technology and services, the transition has not been fast enough to generate strong, consistent growth, and this slow growth becomes a problem when combined with another major factor, which is an aging population, because like many developed countries, Finland is experiencing a demographic shift where the number of elderly people is increasing while the working age population is shrinking. And this creates pressure on the economy because fewer workers are available to support a growing number of retirees, which increases the burden on social welfare systems and reduces overall productivity. And as the workforce shrinks, economic output growth slows down, tax revenues become limited, and government spending increases, especially on healthcare and pensions. And this imbalance can lead to long-term fiscal challenges if not managed carefully. And at the same time, Finland's high standard of living also comes with high costs, including high taxes and expensive labor, which can make it less competitive globally, especially in industries that rely on cost efficiency. And this creates a situation where businesses may find it more attractive to operate in countries with lower costs, which can impact domestic job creation and investment. And although Finland remains innovative and technologically advanced, maintaining competitiveness in a globalized economy requires constant adaptation, investment, and policy adjustments. And this is further complicated by external factors such as global economic conditions, trade relationships, and geopolitical tensions, which can affect exports, investment, and overall economic stability. And as these pressures build, Finland faces a delicate balancing act between maintaining its high quality of life and ensuring long-term economic sustainability. Because reducing social benefits could impact happiness and social stability, while increasing taxes or debt could create financial challenges. And this is the core of Finland's quiet economic crisis. Not a dramatic collapse, but a slow structural challenge that requires careful management, strategic planning, and long-term vision. And this raises an important question. Can a country remain the happiest in the world while facing economic headwinds, and what adjustments are needed to ensure that both happiness and economic stability can coexist in the future? And this is where the real story beginning. But what makes Finland's situation even more interesting is that this is not a crisis in the traditional sense. There are no collapsing banks, no hyperinflation, no massive unemployment spikes, and no visible economic disaster on the surface. Instead, it is a slow structural pressure building underneath a stable system, which makes it far more difficult to detect and even harder to solve, because when a country is performing reasonably well, there is less urgency for radical change. And this is exactly where the risk lies, because small, long-term problems can compound into larger challenges if they are not addressed early. And in Finland's case, the combination of slow growth, an aging population, and high public spending creates a scenario where the current model may become increasingly difficult to sustain over time, and this forces policymakers to consider difficult trade-offs because maintaining generous welfare systems requires strong tax revenues. But increasing taxes further can reduce incentives for work investment and business expansion, which can slow growth even more. And this creates a delicate balance where the government must find ways to boost productivity, innovation, and economic output without undermining the very systems that contribute to Finland's high levels of happiness and social stability. And one of the key strategies Finland has been exploring is increasing productivity through technology, education, and innovation, because if the number of workers is not growing, then the output per worker must increase, and this means investing heavily in research, digital infrastructure, and advanced industries that can generate high-value economic activity. And Finland already has a strong foundation in this area with a highly educated workforce and a culture of innovation. But scaling this into sustained economic growth requires continuous effort, global competitiveness, and the ability to attract talent and investment from around the world. And this brings another challenge, because attracting skilled workers and entrepreneurs often requires policies that make a country appealing, not just in terms of quality of life, but also in terms of economic opportunity, career growth, and financial incentives. And while Finland scores extremely high on quality of life factors, its high tax environment and relatively small market size can sometimes make it less attractive compared to larger economies with more dynamic growth opportunities. And this means Finland must find ways to balance its social model with policies that encourage entrepreneurship, investment, and international talent inflows. And at the same time, globalization itself is changing, creating new opportunities and new risks, because technological advancements, remote work, and digital services are reducing the importance of geographic location, which means talent and businesses can operate from almost anywhere, and this increases competition between countries to attract and retain economic activity. And in this environment, Finland's success will depend on its ability to adapt its policies, invest in future industries, and remain competitive while preserving the social systems that define its identity. And another important factor is fiscal sustainability, because as government spending continues to